Hello and welcome back to Core Finance. I'm Matt Brown, and it gives me, as always, great pleasure to introduce onto the show Mike Ingram, who is a strategist at BGC Partners. You well today, Mike?
I'm good, Matt. Thank you very much.
Well, thank you very much for coming on. We're going to look ahead at Jackson Hole. That's kind of one of the key events for this week. Just talk through central banks and the balance sheets, and how much they're spending and what they're going to do when they need to stop spending. So if you can just talk us through the slide you've kind of
Well, the theme of the symposium this time around is fostering, sustainable global economic growth, which we know has been relatively sluggish post-crisis, despite unprecedented monetary stimulus collectively from the world's central banks. We've seen a lot of speculation that Mario Draghi might be talking about tapering the balance sheet. I don't think that's actually going to be the case. In a nutshell, the reason I don't think that's going to be the case is the last time we had the Monetary Policy Committee, he basically said that they hadn't tasked any committees with looking at options for tapering ahead of their September meeting, and they hadn't even decided what the agenda was for the September meeting, let alone what they were going to do after September. So I think we're still a little bit early in jumping down. What I thought was interesting, and the reason why I wanted to go back to where central banks' balance sheets are going, and that chart tells you up unambiguously, is that Janet Yellen, who's nobody's really focusing on too much this time round, is choosing to talk about financial stability. Now, as some of your viewers may remember, back probably 3-4 months ago, I said that the language of the Fed and what the Fed was doing didn't match up with the data that was coming in, because the Fed's always saying, well, we're data-driven, but there was a mismatch. And I said, well, it appears to me that the Fed is actually shadowing a financial stability objective without actually coming out and saying it. And this is followed by people such as Janet Yellen herself opining on the level of equity market, saying, well, they look a bit toppy, which I don't think has happened since Greenspan's irrational exuberance comments back in the 1990s.
So actually looking at asset classes and asset bubbles potentially.
Yeah, just saying that
could be a risk.
Yeah, maybe that risk generally is being mispriced, and we've been reminded over the last 2 or 3 weeks with Trump's more recent tweet storms that these things can move markets, and very little risk had been priced in, very little implied volatility being priced in. But anyway, irrespective of when the Fed starts tapering, most people think it's going to be in the fourth quarter, probably an announcement in the September meeting. It's very clear that the direction of I've got 4 central banks. I put the BoE, Bank of England, in there, just for completeness. And we are in the UK after all, but it is frankly it's a bit player in the grand scheme of things. Bank of Japan is churning out something like an extra 700 billion US per annum at the moment. ECB, European Central Bank, about 800 billion per annum. So even if the Fed starts to taper, and it will be very gradual, the direction almost certainly is going to be up. And we're talking about ECB's exit strategy. The Bank of Japan at the moment has no exit strategy, and their balance sheet will probably it'll nudge up towards 100% of GDP, Japanese GDP, this year. So people are saying, well, look, hang on, all this balance sheet expansion, what's it done? We've had an economic recovery, but it's been mediocre. Productivity growth has been very, very weak. It's been particularly weak in the UK. Where has all this cash gone? And the reason why I think you're looking at financial stability might be very apposite and important this time around. If you flick over to the second slide I presented, interesting little metric I put together. This is the number of hours, as they say, an average US worker needs to work to buy 1 share in the S&P 500. Now, and I titled the slide, Wall Street versus Main Street. And this implies, well, this has been great at pumping up the price of the S&P 500. It hasn't necessarily been good at delivering wage growth to the person on the street, as it were.
So and that's why distribution of wealth.
Yeah, and that's why the equity market is, to a large extent, is unaffordable. In fact, on this measure, I've got data going back to '64, which is as far back as I could go. But we've now surpassed the .com level of affordability. And by the way, this understates the lack of affordability, because this is the average worker. We all know that it's skewed, the wage growth is skewed to the higher end. So if you look at the median worker, it'd be even worse. So there's an idea that, great, you central banks, you've pumped in over $15 trillion, now, on that first slide. Where's it gone? It's largely gone to financial asset prices. It's delivered a mediocre recovery. It's delivered very mediocre productivity growth. It's delivered very little wage growth for the vast majority of workers in the US and elsewhere. It really is this mixture, where we want to go. Is it sustainable? I think most people at this stage would probably say no. The problem is, it's the old adage, is, if you've got a hammer, every problem looks like a nail. If all you've got a monetary policy, all you're going to do is employ monetary policy. We all know that governments basically are a clueless bunch. And frankly, the political turmoil that we're seeing in many parts of the world, we're not going to single anybody else out, other than Donald Trump, is not helping. So I'll be very interested to see what Janet says. As I said, I think Draghi is going to be a bit of a damp squib, but pay attention to Janet.
We'll keep an eye out for her. 2 questions before we go very briefly. QE, has it worked?
It depends what you think it's supposed to deliver. Because it was supposed to deliver on. See, the problem is that we always end up being in a conversation about the counterfactual. So they say, well, it would have been worse had we not done it.
Exactly.
Without a time machine, nobody can. I can't argue against that, but also you can't necessarily confirm that's the case. I think that QE was a necessary evil, or would have been a necessary evil, relatively early on in the financial crisis. Now I think it's part of the problem rather than the solution. Part of QE was supposed to actually pump up asset prices. So you'd say they delivered that in spades, but the problem is to some extent that's all it's done.
Yeah, overinflated. And secondly,
Yes.
when we unwind, or the central banks start to unwind QE, what impact will that have on the market?
It should increase risk spreads. So, for instance, one of the things that is getting the market a little bit edgy on European Central Bank tapering, or the prospect of that, is what's it going to do to periphery debt. There's no doubt at all that it's helped to drive down spreads between, for instance, Bunds and Italian bonds. We know that the political situation in Italy is somewhat fragile. There's probably going to be early elections next year, and the economic situation isn't particularly pretty either. So certainly there should be some repricing of risk, because after all, QE was supposed to compress risk premia. It's only logical we're going to see those expand again on the backside.
Well, we've got that to look forward to.
We have.
Thank you very much for joining us today.
My pleasure, Matt.